Watch this video all the way through. I know you have seen me say that before. I know every channel in this space opens with some version of that request. But today I need you to understand why I am saying it with more urgency than I have felt in any video I have published in recent memory. Because what is happening simultaneously in the silver market right now, the price weakness to $82, the vault drainage data, the Jane Street position, and what NFP Friday means for all of it. These are not four separate stories. They are four data points in the same story. And that story only makes sense when you see all four together in the right sequence. If you watch half of this video, you will have a fragment. If you watch it on 2x speed, you will have the words without the weight. What I am asking for is 10 minutes of your complete attention, because the decision you make about your silver position in the next 72 hours, whether that decision is to hold, to add, to reduce, or to do nothing, will look very different depending on whether you have the full picture or only part of it. Here is what is on the table right now. Silver is weakening toward $82. At the same time, millions of ounces are physically leaving COMEX and LBMA registered vaults at a rate that has not been seen in years. Simultaneously, Jane Street, one of the most sophisticated and well-capitalized quantitative trading firms on the planet, has taken a $5 billion position that touches the silver market directly. And on Friday, the Non-Farm Payrolls report drops, the single most market-moving scheduled macro data release on the calendar, the one event that has historically produced the sharpest, fastest, most violent silver moves in both directions. Fourth thing, one 72-hour window, one decision point. Stay with me. Before I break down each of these four data points, I need to say something that has been sitting with me for the last 48 hours as I have watched this situation develop. There is a specific kind of market moment that is more dangerous than a crash, more dangerous than a sharp correction, more dangerous than a sudden violent move in either direction that forces an immediate decision. That moment is when multiple significant signals are present simultaneously and pointing in different directions. When the vault drainage data says one thing and the price action says another. When a sophisticated institutional player like Jane Street is positioned in a way that raises more questions than it answered. When a major macro catalyst is 72 hours away and the market is sitting at a technically fragile level. These are the moments that produce the most lasting financial damage to retail investors. Not because the outcome is necessarily negative, but because the complexity paralyzes decision-making. Because when signals conflict, the human brain defaults to the most emotionally available interpretation rather than the most analytically sound one. And in a market as narratively charged as silver, the most emotionally available interpretation is almost always the wrong one. What I am going to do in this video is cut through that complexity, each data point clearly, each one in context, and then the picture they create together, which is more coherent than it might appear on the surface right now, laid out in a way that gives you a framework for navigating NFP Friday with clarity rather than anxiety. That is what the next 10 minutes are for. Let me build this layer by layer. Every piece connects to the next. Layer 1. Silver at $82. What the weakness is and is not. Silver weakening to $82 is generating significant concern across the retail precious metals community right now. I want to be precise about what this price level represents analytically, because the emotional response to a falling number and the analytical response to a falling number are very different things and lead to very different decisions. The move to $82 is not a fundamental repricing. The supply deficit that has characterized the silver market for 4 consecutive years has not resolved. Industrial demand from the solar, electronics, and defense manufacturing sectors has not contracted. The monetary demand thesis driven by dollar debasement concerns, central bank gold accumulation, and BRICS de-dollarization momentum has not reversed. What has happened is a technical deterioration driven by a specific combination of factors that are temporary in nature, but that have real short-term consequences for price. The first factor is dollar strength. The dollar index has been strengthening on the back of relative safe haven flows, driven by global risk-off sentiment. Silver, priced in dollars, faces mechanical downward pressure when the dollar strengthens. Not because silver is worth less fundamentally, but because the currency it is denominated in is worth more relatively. This is a mathematical relationship, not a fundamental one. It reverses when dollar strength reverses. The second factor is the unwinding of leveraged long positions in the managed money category. As I described in the signal analysis I published previously, managed money net longs in silver reached statistically extreme levels. That positioning unwind, hedge funds and algorithmic strategies reducing long exposure, creates consistent, sustained selling pressure that is not driven by any fundamental view on silver's value. It is driven by risk management and profit-taking at the institutional level. This unwind has a finite duration. It ends when positioning normalizes. Based on the rate at which the unwind has been occurring, we are likely in the middle to later stages of that process, not the beginning. The third factor is the 72-hour shadow of NFP Friday. As the non-farm payrolls release approaches, Market participants reduce exposure to volatile assets ahead of the data. This pre-NFP positioning reduction is a consistent calendar-driven pattern across commodity markets. Silver experiences it acutely because of its dual sensitivity to both monetary policy expectations, which NFP data directly influences, and risk appetite. The weakness you are seeing in the $82 level right now is partially a pre-NFP positioning reduction event. When that event passes, when the data drops and the market reprices, the pre-event selling pressure lifts. $82 is not where silver's fundamental value is. It is where silver's paper price is sitting under the weight of three temporary, converging pressures in the 72 hours before the most significant macro data release of the month. Layer 2. Millions of ounces leaving vaults. The signal everyone is misreading. Now here's where this story gets genuinely interesting, and where the divergence between the paper price signal and the physical market signal becomes most stark. While silver's paper price has been weakening toward $82, the vault drainage data from both COMEX-registered vaults and ELBMA-eligible stocks has been showing something that appears to contradict the price action entirely. Millions of ounces of physical silver are leaving registered and eligible vault stock. The withdrawal rate over the last 30 days has been running at a pace that places it among the most significant vault drainage events of the last several years. The retail narrative around vault drainage is almost always the same. Silver is leaving vaults because buyers are taking physical delivery. Physical demand is overwhelming supply. The squeeze is coming. Buy now. I want to give you a more nuanced and more analytically complete picture of what vault drainage actually means, because the simple narrative, while partially correct, misses critical context that determines whether this specific drainage event is bullish, neutral, or a warning signal depending on where the metal is going. There are three reasons physical silver leaves COMEX and ELBMA registered vaults. The first is genuine physical delivery to end users, industrial manufacturers, mints, refiners who need actual metal for production. This is structurally bullish because it represents real offtake reducing available supply. The second is transfer to non-COMEX storage. Investors and institutions moving metal out of exchange-registered vaults into private storage facilities, typically because they want allocated physical metal outside the exchange system. This is neutral to mildly bullish because it removes metal from the exchange visible supply pool without necessarily reducing total above-ground silver stock. The third is arbitrage-driven movement, metal moving between vault systems in response to price differentials between the COMEX, ELBMA, and Shanghai market. This is structurally neutral and tells us more about geographic price dislocations than about fundamental demand. The current drainage event appears to be a combination of the first and second category, genuine industrial offtake, combined with institutional withdrawal into private storage. The industrial offtake component confirms that physical demand at the fundamental level remains robust, even as the paper price weakened. The institutional withdrawal component confirms that a category of large capital is actively moving metal outside of exchange infrastructure, which is consistent with the broader narrative of institutional distrust of paper settlement systems that I have covered extensively on this channel. What this means practically is this. The vault drainage that is occurring simultaneously with the paper price weakness to $82 is the physical market communicating that $82 does not represent the real scarcity value of silver at the current supply and demand configuration. Industrial buyers are still taking delivery. Institutional money is still moving metal into private storage. The physical market is not confirming the paper price signal. It is contradicting it. When the paper market and the physical market send contradictory signals simultaneously, one of them is telling the truth about value, and one of them is telling the truth about price. They are not the same thing. And historically, in every major silver inflection point of the last 4 decades, it is the physical market that turns out to have been correct. Layer 3. Jane Street's $5 billion position. What it actually means. Jane Street is not a name that appears in retail financial media often. For those unfamiliar, Jane Street is one of the most sophisticated quantitative trading and market-making operations in the world. They manage hundreds of billions in assets across global markets. Their edge is not narrative or thesis-driven investing. Their edge is data, speed, and structural insight into market mechanics that very few participants can match. When Jane Street takes a $5 billion position that touches the silver market, the retail instinct is to immediately ask which direction they are positioned. Are they long? Are they short? Are they betting on a crash or a breakout? That instinct, while understandable, misses how a firm like Jane Street actually operates. Jane Street is not making a directional bet on silver the way a retail investor or even a traditional hedge fund makes a directional bet. They are almost certainly operating a sophisticated multi-leg structure that profits from volatility, from spread relationships, from the convergence between paper and physical pricing, or from the specific dynamics of the NFP catalyst I am about to describe. What the $5 billion position tells us is not direction. What it tells us is that a firm with the most sophisticated market intelligence available to any private participant on Earth has identified something specific and actionable in the silver market right now. They have identified a structural opportunity significant enough to deploy $5 billion into, and that opportunity is almost certainly connected to the NFP Friday catalyst, the vault drainage dynamics, and the current paper physical diversion, all of which are live simultaneously right now. You do not need to know exactly what Jane Street is doing to extract value from the fact that they are doing it. What you need to know is that the presence of a $5 billion position from the most data-sophisticated firm in global markets confirms that there is a structural opportunity in silver right now that goes beyond the retail narrative. Something in the mechanics of this market is creating conditions that the most capable analytical operation on the planet has decided is worth $5 billion of exposure. That is not a bullish or bearish signal. It is a signal that the next move in silver is significant, and that its mechanics are more complex than a simple directional call, which means the 72-hour NFP window is not just important for retail investors. It is important at the highest levels of institutional participation. Layer 4, NFP Friday, the test that decides everything in the near term. Non-Farm Payrolls is the single most market-moving scheduled macro release on the monthly calendar for silver. The reason is precise. Silver is uniquely sensitive to NFP because it sits at the intersection of two macro frameworks that the data simultaneously affects. Strong NFP data signals a resilient economy, reduces expectations for Federal Reserve rate cuts, strengthens the dollar, and creates pressure on silver from its monetary safe haven function. Weak NFP data signals economic softening, increases rate cut expectation, weakens the dollar, and removes that pressure, while simultaneously raising inflation concerns that strengthen silver's monetary appeal. No other monthly data release hits both of those frameworks simultaneously with the same force that NFP does. Friday's release is arriving at a moment when silver is sitting at $82, a technically fragile level, with massive vault drainage confirming physical demand, Jane Street's $5 billion position confirming institutional attention, and the paper physical divergence at its most pronounced in recent months. A weak NFP print in this configuration, strong physical demand, paper price suppressed, institutional positioning present, pre-event selling pressure ready to lift, creates conditions for a sharp, fast recovery move that could retrace a significant portion of the recent weakness within hours of the data dropping. A strong NFP print in this configuration extends the dollar strength, delays rate cut expectation, and creates conditions for silver to test lower support levels below $82 before the physical market's fundamental pressure reasserts itself. Both outcomes are live, both have analytical support, and the decision you make before Friday, hold, add, reduce, or do nothing, should be made with a clear understanding of both scenarios, rather than a confident prediction of one. Every data point in this video is publicly verifiable. The COMEX-registered vault inventory data and LBMA-eligible stock reports are published daily and weekly respectively, and are accessible through the CME Group and LBMA official website. The drainage figures I cited are in the current public record. I have linked the most recent reports in the description. Jane Street's position disclosure came through regulatory filing requirements that are a matter of public record. The filing is linked in the description. You can verify the position size and the instruments involved directly from the source. The historical relationship between NFP data and silver price behavior across the last 20 years of monthly releases is documented in the academic commodity finance literature and in the professional research published by major commodity banks. The pattern of pre-NFP positioning reduction in silver is statistically documented and reproducible. The dollar index relationship to silver pricing is a mathematical relationship that is verifiable in real time on any charting platform. The current dollar strength and its mechanical impact on silver's dollar-denominated price is calculable by anyone with basic charting tools. I want to say something directly about how this video is different from most of what you will see covering this story today. Most coverage of silver at $82 with vault drainage and a major institutional position, and NFP Friday approaching, will do one of two things. It will either catastrophize, silver is collapsing, the bull case is over, get out now, or it will overcorrect in the opposite direction. The vault drainage proves the squeeze is coming, Jane Street is going long, NFP will be the catalyst for a moonshot. Both of those narratives are emotionally satisfying, both of them are incomplete, and both of them are designed to generate engagement rather than understanding. What I have tried to give you in this video is something harder to produce and less immediately exciting than either of those narratives. A complete picture, 4 data points in their proper relationship to each other and to the macro event that will stress test all of them on Friday. That complete picture does not resolve into a simple buy or sell signal. It resolves into a framework, a set of conditions, a set of scenarios, and a clear understanding of which data points matter most in the next 72 hours, and why. That framework is less viral than a price target. It is considerably more valuable than one. Here is what I need from you before you close this video, and I will be direct about why each thing matters specifically in this 72-hour window. First, like this video right now, not eventually. The algorithm's decision about whether this analysis reaches the people who need it before NFP Friday happens in the next few hours. Every like in this early window has disproportionate impact. NFP Friday is 72 hours away. The window for this analysis to reach people before it becomes relevant is now. Second, leave a comment telling me your current position and your NFP plan. Are you holding silver into the number? Have you reduced exposure ahead of the event? Are you planning to add on a weak NFP print? Are you watching from the sidelines? Tell me exactly where you are. I am actively monitoring comments on this video, and your answer shapes the follow-up analysis I publish immediately after the NFP data drop. Third, share this video with one person who is currently confused about what is happening in silver right now. Because the combination of price weakness, vault drainage, a major institutional position, and a macro catalyst on the same 72-hour horizon is generating enormous confusion in the silver community right now. Someone you know is sitting with that confusion and no framework to resolve it. This video gives them that framework, but it only reaches them if you share it before Friday. After the data drops, it becomes a postmortem. Right now, it is preparation. Those are very different things. Before I end this video, I want to say something that I think is the most important thing I can say right now. More important than the $82 price level, more important than the vault drainage data, more important than Jane Street's position or what NFP Friday might produce. The most valuable thing you can own in a market this complex and this fast-moving is not a better price target. It is not a more sophisticated charting setup. It is not access to the same data that Jane Street has, because you will never have that, and chasing it is a distraction. The most valuable thing you can own is a framework that holds up under pressure, a way of seeing what the data is actually saying versus what the narrative wants you to believe it is saying. The ability to look at silver weakening to 82 while $1 million of ounces are leaving vaults, and a $5 billion institutional position sits in the market, and a major macro catalyst is 72 hours away. And to see all of that clearly, without panic, without euphoria, without the emotional noise that makes most retail investors consistently wrong at the most important moments. That framework is what this video was built to give you. Silver at $82 is not the story. The vault drainage is not the story. Jane Street is not the story. NFP Friday is not the story. The story is the relationship between all four. The story is what the physical market is saying versus what the paper market is pricing. The story is what a $5 billion position from the most data-sophisticated firm on earth tells you about the structural opportunity in this market right now. The story is how Friday's number changes or confirms the scenario that the other three data points are already building. You now see the full story. Navigate Friday with that framework, not with fear, not with blind optimism, with the clearest picture of what is actually happening that you can build from publicly available data and honest analysis. That is all this channel has ever tried to give you. Invest with logic, not hype.